Tesla sold more cars and made more money in the April to June quarter, and yet it has disappointed Wall Street. Because this quarter wasn't about revenue, it was about what Tesla is sacrificing to chase Elon Musk's next big bet. And it's not just Tesla feeling the heat. Even SpaceX, Musk's biggest success story, is losing altitude. Let's decode. Tesla delivered a record 4,80,126 vehicles in the second quarter. Revenue jumped 26% to $28.23 billion, comfortably beating expectations of $25.71 billion. But the stock fell nonetheless. Why? Because investors looked elsewhere in the company's balance sheet. Adjusted net income dropped 17% to $1.2 billion, far below Wall Street's $1.95 billion estimate. On a reported basis, net income slipped 5% to $1.11 billion. Earnings came in at 31 cents per share, well below the expected 51 cents. As a result, Tesla's shares fell more than 3% on Wednesday in after-hours trading. Tesla is selling more cars. It's just making less money on each one. After the US ended the $7,500 EV tax credit, demand weakened, forcing Tesla to cut prices and offer aggressive financing. It also sold more lower-priced Model 3 and Model Y cars after retiring the premium Model S and Model X. Then came another blow. Revenue from regulatory credits, a highly profitable business, crashed to just $146 million from $439 million as the Trump administration rolled back climate regulations. The result? Gross margin fell to 16.8% from 17.2%, missing expectations of 19.4%. Excluding regulatory credits, automotive margins stood at 16.3%, well below forecasts of 18.7%. Operating margin almost vanished, dropping to 1.4% from 4.1%. Tesla isn't behaving like only a car company anymore. While its core auto business still generates over 70% of revenue, Tesla is spending like an AI company. It has more than doubled capital spending, up 142% to $5.79 billion. It is building AI compute infrastructure, semiconductor manufacturing, battery materials capacity, the Cortex-2 supercomputer, and a chip research facility under its Terafab venture with SpaceX. It also began producing the fully autonomous Cybercab, expanded robotaxi operations across Texas and Florida, and is ramping up production of the Optimus humanoid robot. The spending spree pushed Tesla into its first quarterly cash burn in 2 years, with negative free cash flow of $1.1 billion. CFO Vaibhav Taneja has already warned operating expenses will continue rising. Musk's empire isn't under pressure only on Earth. Tesla is down about 17% this year. SpaceX, after its record market debut in June, has lost more than 40% from its peak and is down about 26% since its debut. Yet Musk isn't slowing down. On the earnings call, he again called Optimus the biggest product ever, said robotaxi expansion would remain cautious for safety reasons, and even refused to rule out a future merger between Tesla and SpaceX. For years, investors rewarded Elon Musk for betting on the future. This quarter showed the costs of those bets, and for the first time in a long while, both Tesla and SpaceX are asking investors for something they have rarely needed before: patience. Follow Business Standard for more such stories.